This is an emergency broadcast for your money. In the last 24 hours, two of the most powerful banks in North America made a move that should make you very nervous. This wasn't planned. This wasn't a routine change. This was a signal, a warning. The Bank of Canada and the United States Federal Reserve both cut their interest rates. It was a 1-2 punch that shocked the financial world. They'll tell you this is a good thing. They'll say it's to cool the economy and to give you relief. But they won't tell you what they're really afraid of. They won't tell you that this is a panic button. Today, we pull back the curtain. We're going to show you what this really means for your wallet, your mortgage, and your savings. Because what happened yesterday changes everything. All right, let's start with Canada. For months, the Bank of Canada has been talking tough. They kept interest rates high. They promised to crush inflation. They told everyday Canadians to tighten their belts, that the pain was necessary. Millions of homeowners were squeezed to their breaking point. They were all waiting for just a little bit of relief. And then it came. A rate cut to 2.5%. The official story was predictable. The governor talked about a cooling economy. He said inflation was finally getting better. He said it was time to ease the pressure. It sounds good, right? And for a family struggling with their mortgage, it is a small breath of air. But you have to ask, why now? Why so suddenly? Here's the truth. The Canadian economy is on the edge of a cliff. This wasn't a choice. It was a reaction. For years, Canada's economy has been propped up by one thing: a giant housing bubble. An entire generation was told that real estate only goes up, so they took on mountains of debt. That mountain of debt is the key. The Bank of Canada knows that if they keep rates high, that mountain will collapse. It would cause a wave of mortgage defaults that would make 2008 look like a joke. They saw the warning signs. People are spending less money. Small businesses are closing. The job market is getting weaker. So this rate cut isn't a victory. It's a desperate gamble. They are choosing to save the housing market by weakening your dollar. They're just papering over the cracks, hoping you don't notice how fragile everything is. Now you might think, okay, that's a Canadian problem. But just a few hours later, the U.S. Federal Reserve did the exact same thing. The Fed is the most powerful financial institution on the planet, and they announced their own rate cut. Their reason? They said the job market was cooling. They talked about a soft landing where they fix inflation without causing a recession. It's the same soothing language we heard from Canada. But let's be very clear. It is almost never a coincidence when these two banks move together. The U.S. economy is suffering from the same disease, an addiction to cheap debt. The Fed sees the same warning signs. The American consumer is running out of gas. Credit card debt is at an all-time high. Savings are gone. A cooling job market is just a nice way of saying people are losing their jobs, and wages aren't keeping up with the real costs of living. So they cut the rates. They are sending a signal that easy money is back. They are trying to get ahead of the crisis they know is coming. This isn't about a soft landing. This is about deploying the airbags right before the crash. So, what does all this mean for you? On the surface, it seems simple. Lower rates mean cheaper loans. Your mortgage payment might go down a little. A car loan might get cheaper. And that's what they want you to focus on. They want you to feel that small bit of relief and ignore the bigger picture. The hidden danger is inflation, the very thing they promised to fix. By cutting rates, they are making money cheaper. They are pumping more cash into the system, and when you increase the supply of something, its value goes down. This is just basic math. Every dollar in your bank account just got a little weaker. The price of groceries could start soaring again. the price of gas, the cost of heat, all of it is at risk. They are devaluing your money and calling it relief. And the housing market? This rate cut is like pouring gasoline on a fire. It will make the housing crisis even worse. It will lure in more buyers, pushing prices even higher and locking more people out of ever owning a home. Here's the bottom line. The central banks have admitted that our economies are too weak to survive on their own. They've admitted the only way to keep the system from falling apart is to go back to the drug of cheap money. This was not a move made from strength. It was an act of desperation. They are scared, and you should be paying attention. So, where do we go from here? The central banks have chosen their path. More debt and a weaker currency to avoid a recession today. Will it work? Maybe. For a little while. They might kick the can down the road for another year or two. The stock market might go up. The housing market might get another sugar high. But the real problems haven't been solved. The mountain of debt is bigger than ever. The system is more fragile, not less. They have traded a short-term crisis for a long-term rot. And when that bill finally comes due, it will be much, much worse. The most important thing you can do is understand what's really happening. Look at what they do, not what they say. They just showed you their hand. They're afraid. This is the kind of analysis we bring you every single day. We cut through the spin and tell you what's really going on. If you believe it's more important than ever to stay informed, then I urge you to subscribe to this channel and hit that notification bell so you never miss an update. Let me know what you think in the comments. Is this a smart move or a catastrophic mistake? Thank you for watching. Stay informed and stay vigilant.